All right, guys, this is going to be recorded. We are recording as we speak, and this options workshop is going to be a strategy we can use with a bearish assumption, which is kind of weird to talk about when all we've seen are lifetime highs in the past week or so. At some point in time, we do need to start thinking about protecting to the downside. So this actually could be a really good opportune time to do it. Also, this is a great setup for earnings for stocks we don't really love or want to protect to the downside. And the reason why is because we've just come out of earnings season, and volatility is really low. So it's a good time to start implementing this strategy. Before I get into all those details, let me go over a couple of things real quick. My name's Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical market analysis. I started trading in college with some money I had earned while getting a psychology degree, and decided to switch it over to finance about a year and a half into my college career, I guess, if you will. And upon graduating, I moved to Chicago to start working at the Board of Trade and started trading on the floor there. So in that time, I've traded just about everything. I've traded stocks, financial futures, commodities, currencies, and options on all these products in all market conditions. So I've seen a lot of things and traded right through them. As a matter of fact, one thing on the floor we used to say, when there's blood in the water, that's the time to go fishing. So don't ever get to that point where you think that, you know what, it's just a little too crazy out there for me to trade. That's probably the best time to actually take advantage of what's going on. Anyway, let me get over this disclaimer. Any opinions, news, research, and analysis or other information contained here are material provided by ProTrader Strategies, associate companies, or employees, is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of the securities or strategies that we talk about. The reason why is because I don't know what's in your portfolio. I don't know what your risk parameters, and unless I knew all of those things, I wouldn't be able to give you real advice. So, you know, not having that, we are here to just teach you these things and take what we teach you and implement it into your portfolios in your own way. Last but not least, bottom line is do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. You got all that, Janice? All right, or Jans, sorry. Hey, Trevor, good to see you back. All right. One other thing is you guys can follow us on Twitter. You can follow me at Wolfman's blog, and you can follow us at ProTrader Strat for any updates of different types of webinars and different news articles and things of that nature. You can follow me for trading snark and whatnot. And this workshop is going to be on the diagonal put. And like I said, it's a bearish assumption. So this is one of my favorite trades to start putting on right here after the earnings events have happened, because it really allows us to put on puts for or calls, which we just did the call one last week. And as a matter of fact, I just covered my ConocoPhillips. So if you guys have been watching the daily market commentaries, you know that on Monday, I usually put on the trade that we talk about or that we kind of come up with during this webinar live. And then I put that on Monday, because I can't obviously put it on right after the close, but I try and put that on Monday. I put on ConocoPhillips and took it off for 50% of my max profit today, almost right at the close. It got filled. So that one worked out quite nicely. This is going to be on the put diagonal. So if we can hold it on to the end or take our profits when we get to that 50%, which is what I did with ConocoPhillips, and I had it on for what, 3 or 4 days. So it worked out quite nicely. you're always waiting for my webinars. Good to know, Jans. All right, so let's get into the put diagonal. Like I mentioned, it is a bearish assumption. It could be considered neutral because we really don't want this thing to really fall out of bed because we're bearish right away. We like it to kind of trickle down, kind of like what ConocoPhillips did. It did have a big move, but I got lucky this the volatility came in a little bit even more and allowed me to take that profit. With this one, it's a little bit more sensitive to the down move because we'll see that volatility expand. We don't want to see volatility really expand in that front month we're short. We'd rather have it kind of take that theta decay out and then after get that volatility expansion, because the puts are a little bit more sensitive to volatility expansion than the calls are. All right, so this is the way we set it up. We sell an out-of-the-money put in the near expiration, and then we buy an in-the-money put in the further duration expiration. So right now we're going to be kind of looking at Jan and then Feb. And a lot of people will quote this backwards, or actually I quote it backwards compared to what most people do. And that's just a floor thing, the way that we would build it out by thinking in the front month first and then go to the back month to put on our long put. So I think about it a little bit differently, and I'll show you why I think about that a little bit differently when we're talking about this. Really what we're trying to do is sell that put option that we want to expire relatively worthless and use that credit to finance the extrinsic value of that further duration option. So that's why I look at it a little bit backwards to what most people do. They will look at that further expiration and quote it as the Feb Jan diagonal. I quote it as the Jan Feb just because I'm looking at Jan first. So not to try and confuse anybody, but I think you'll understand why when we start doing this. And yes, SK, this is a debit spread, which is why you want to do it when we have really low implied volatility, which is what the kind of environment we have right now. Trevor's asking, is the call diagonal also good after earnings too? Absolutely. This is something that we would want to implement after earnings or just in general with really low implied volatility. The thing is to make sure that there's not an earnings event or a binary event in that front month. We want to make sure that earning event, if there is one, is in that further duration expiration. Can I do a in-depth IV class similar to what you did a few days ago on the, I think you're talking about on the Festival of Traders? Absolutely, Trevor, that's a good idea. If some of you guys missed that Festival of Traders webinar, that went off pretty good, I think. Because a lot of people don't talk about implied volatility. Everybody talks about theta decay and deltas and stuff like that. And the most important thing to me is that implied volatility. And the reason why, one thing, Trevor probably knows this, when we talked about it on the floor, we used to call theta and vega the thieves in the night that would come steal the buyers or the option buyers' money. Those are the two things that can rapidly decay those premiums against you. Even if you're directionally right, you could see that those two steal your money. Anyway, so picking the right strike. Now this may seem a little counterintuitive. It seems pretty obvious. A lot of people just kind of pick one strike in the money and one strike out of the money for those. My thing with this is we need to make sure that with that front month, we are selling the out of the money put. That collection of credit is going to finance our extrinsic value of that put that is in the money. Now remember, puts that are in the money have intrinsic value and extrinsic value. We're trying to pay off that extrinsic value so that the decay will offset them. And then we have those puts on for their real value, if you will. And we, like I mentioned before, we don't want this to shoot down too fast, because that expansion in volatility will affect that front month and kind of hurt us a little bit. But the deeper in the money options will have less extrinsic value too. So that will allow us to achieve some of our rules that we come up with here going forward. Picking the right duration. The reason why I say picking the right duration, we want to pick something where we're selling in this slope. This is the slope where the most decay happens. And then when we get back further, this is where we're going to be buying, so we don't get that theta decay coming out of our premiums. So we're going to be trying to hold on to our theta decay here and exploit theta decay in the near duration. That's why we're selling here and buying out here. Jans, I don't know what you're saying. I missed. That would be great. Is that on the implied volatility? And picking the right environment, I've mentioned this a couple of times. We want to make sure we have low vega, as low vega as we can. And we also want to make sure that our expiration cycles, the near-term expiration cycle and the further duration expiration cycle, are very close in proximity to one another. I like to call it right around 2 percentage points. And when I pull up the trading platform, we'll talk about that a little bit more. I'll show you how you can see where those volatilities come in line. But we want those to be relatively close. The reason why is we don't want that further duration that we're buying have a lot more implied volatility embedded in it, because we're paying more than for that option. We're paying more extrinsic value there, and we wouldn't be getting a lot of extrinsic value for those options that are out of the money. So we want to make sure they're very close in proximity. So that's really important with this in picking the right environment. All right, picking the right underlying. We want to have volume and open interest in this. One of my rules of thumb with the options is when there's an underlying that's trading $100 or less, we want that bid ask to be 10 cents wide or less. Another thing is I talk about if it's over $100, move that decimal point 3 ticks to the left, and whatever that penny increment is, then that's probably your ballpark on how wide that bid ask should be. So for instance, if it's a $300 underlying, we move that 3 ticks to the left, that gives us 30 cents. So our bid ask on that option cycle should probably be right around 30 cents. Something like Priceline, $1,500 stock or something like that, 3 ticks to the left makes it about $1.50 wide. So you don't want to go any wider than that on your bid ask. Is the put diagonal a cheap way to buy puts? If that's the case, why not do a debit put spread? Good question. You could do a debit put spread, but what we're trying to do is, capture a longer duration in this. A debit put spread you could do, but you're also limiting some of your profit potential. With this, we're trying to do this as a diagonal and capture more profit potential on a down move after that front month expires. So if it's just kind of trading sideways, then we'll be able to achieve that. Otherwise, we'll be just looking to take our 50% of our max profit in a sense. So I like to cover it for 50% of my max profit. Generally, don't usually let it ride that much longer. I'm going to take my money and run for the most part, just like I did with ConocoPhillips. All right, so know our exit strategy. I talked about this. When we reach 50% of our max potential profit, that's when we're going to look to cover. Another thing, we're going to try and design this so that we aren't paying any more than 75% the width of those strikes. So quick example, if it's 10 ticks wide, or it's the 90 puts and the 100 puts, we've got 10 ticks wide there. We pay $7.50. That'd be 75% the width of the strikes, right? $7.50 would be. And then our max profit would then be $2.50. What I'm looking for out of this trade in that particular scenario would be $1.25 credit. So when the market when I paid $7.50, when it's trading $8.75, that's when I'm looking to get out. You know, if it happens really fast, like with ConocoPhillips today, I didn't get quite 50% the max profit, but I was like, I am right there. It only happened a couple of days. I didn't take that much risk. I'm going to look to cover it. And that's why I covered that one a little bit sooner than exactly 50% of the max profit. So our profit, I ran over this kind of quickly just a minute ago. It's the width of our strikes minus that net debit we paid. So in that example, we had $10 wide, paid $7.50. Subtract the $10 from the $7.50, we get $2.50. That is our max profit. Now it could be unlimited if we allow that front month to expire, worthless, and then we have that put on still. So, you know, if the market fell out of bed, then we would be able to have relatively unlimited. You know, it can only go to zero. So from wherever we got it at to zero is then becoming our max profit. And then the max loss, anytime you pay a debit for something, that is your max loss. You can't lose any more than that. So keep that in mind. You know what your risk is getting into this, and that's the beauty of doing a debit spread. Anytime you do a debit spread, that's, you know what your max loss is, and that is the debit you pay. Okay, our break even, this gets a little confusing to some people, but it's that long put that is in the money that's higher than where the underlying is trading minus the net debit paid. All right. Another thing we want to do with this is we would like to build this out where our break even is exactly or is slightly higher than where the underlying is trading. If you remember when we did the call diagonal, I talked about you want your break even below where the underlying is trading because we're bullish. Now in this particular example, we are bearish, so we want our break even to be above where we are. So we're already profitable in a sense, all right? All right, so Jans, that's why you like debit spreads, because you know where your risk is. There's that. I like the credit spreads personally, and that's the reason why I like the credit spreads is because they have a higher probability of profit. So, but we'll get into, so this is usually where I kind of start talking about the platform, and I ask you guys to make this kind of back and forth so you guys can get a little bit more out of it. Start throwing out some ideas, different stocks you would be bearish on or you think may have a potential to come off a little bit. I don't really know that the SPY is, but I was kind of looking at it earlier. This is what I was talking about with the volatility, the implied volatility difference. So if we're looking at Jan and Feb because we want to capture the theta decay coming into that deeper slope in the front and have theta decay hold off a little bit in these further duration months, then we want to make sure that they're relatively tight within 2 percentage points. So this is 1238 and we're looking at 1413. So that is within that 2 percentage points difference. Sometimes you will be, on a very rare occasion, be able to see the puts up here higher than even further back. And as long as there's not a binary event in this one, that sets up for a really nice trade, as long as there's no binary event there. So make sure you get that. All right, so everybody's starting to throw out a couple of them. Somebody likes the emerging markets. These guys have a tendency to get wide every once in a while, but it looks like they're pretty tight. So they're within, you know, it's $36 stock. We've got 3 ticks wide, so that's really nice. We've got a 19 volatility here, 1971 and 2071. This works, looking like it's working out really good. One other thing is, with this one, we want low implied volatility. So you guys know when I'm talking about high implied volatility, EEM is an ETF. So above 30, we would be selling option strategies. Below 30, we would be buying option strategies in this, and its current IV percent is 1. So it is at the pretty much low of its move. So if you're bearish emerging markets, we would want to look at the calls and the puts. I usually default to looking at like the 30s, or sorry, looking at the 30s here, 30 delta that is. So we'd be able to capture about 50 cents. So we're going to want to sell the 35 puts, and then we're going to try and pay for the extrinsic value of our puts we're going to be buying. And the cheapest or the easiest way to look at it is a little trader hack. You look over here, and it is a ballpark, but it is usually very close. And on the floor, we used to use this all the time because then you didn't have to do all the math. You didn't have to pull out your calculator, figure out all the intrinsic and extrinsic value. You can basically look at what you're paying for. Over here is the extrinsic value of the corresponding puts. So with 55, 56 cents, I can say that that's going to pay for the extrinsic value here. So this is the one that we're going to want to buy. All right, so we'd be paying a debit of $1.61. Now, the next thing we have to do is figure out where our break even is. We want our break even to be above where the underlying is trading. So the easiest thing to do is take out the take those 37.5 puts, right? So we got 37.5 puts minus the $1.61 that we're paying for it, 35.39. So 35.39, did I do that math right? Is below where we're trading. So I don't know that we want to do that one. That's way off. $37.50 minus the $1.61 we're paying. Oops. $1.61 we're paying. Yeah, so 35.89. So we'd have to have a sell-off of 35 cents or something for that to become get, you know, to our break even. We would rather have it be something like 36.89, where then our break even is above where we are. The other thing we would look at, like if you were really bearish this and wanted to just go through all the rules and see if it made sense, you know, we got $2.50 wide strikes because it's gone from 35 to 37.50. Take the $1.61, divide that by the $2.50 wide strikes, and that should give us percentage. So that's inside. That rule falls in line. It's below 75% the width of the strikes. That's good. So now what we can kind of do is look around and say, all right, maybe we could make this work by going with the 34 puts. So the 34 puts, and try and finance that by buying these 38s. And oops, so I forgot to buy the 38s and sell those 34s. So now we have $4 wide, $2.21. So that puts us at 35.80-ish, right? Just double check my math on that. So we'll take those puts, take the 38 puts minus the debit we paid to find out where our break even is, and hopefully it's above where we are, 35.79. So that's still below where we are. So I would probably look to scrap this one, just because, you know, I don't know if I want to take that on. I mean, it was down 20 cents today, but if you're really bearish this, then, you know, you have to do that yourself. Think about it. I'd prefer to maybe put this on a short list and go and see if there's anything else out there that might fit within the all of the rules that might work out a little bit better. All right, so the next one was AMT. You're welcome. So let's delete that one out. AMT doesn't have those doesn't have that option cycle. So let's find out where AMT's earnings are. I mean, we could look at the 26, 25, and the 24. So that's within it. So, I mean, I would be inclined to do that even further out. That kind of helps. And that's actually, it looks like, so we would be able to capture that. Their earnings come out right there in the February. So that might be one to look at. So let's check it out. We can do this. It's 30% ID, so it's below 50. That would kind of work out in that line of reasoning of capturing the binary event, and it's below 50, which is an opportunity to buy options premium. So what we need to do is kind of just look at the options premium on both sides. These are really wide. So American Tower, it's a $100 stock. I would still want these to be within 10 cents wide. They're a little bit wide. The reason why is because if things start getting tough out there, you guys, people are going to fly away from AMT and they're going to go into the Apples and the ones that have the tighter markets, because there's always somebody in there willing to get in and get out. We can also look at the implied or the volume and open interest. You can just see there's not a lot of open interest in these and almost no volume on a daily basis. So that's why the markets are going to be a little bit wider. So this is something that I wouldn't trade, just because for 25-cent wide markets, it's just it's not really worth it for me. Plus, the other problem with that is the deeper in the money you go, you can see the bid ask gets even wider. So people are going to be doing more at the money. So if this starts going deeper in the money, it's going to be really hard to get out. We're going to be giving up like $1 an edge. So yes, you could do, instead of doing the Jan 20s, you could do like the Jan 30s for sure, because that puts there right there at your theta decay number. But in this one, I wouldn't, because those markets are even going to get wider on the weeklies for something that has really wide markets here. Something like Apple or something along those lines where there's everybody participating, absolutely, that would be something to do. But still make sure that they're within 10 cents bid ask for anything under $100 or right around $100. Okay, we got Merck. Brian, I haven't forgot about you. We'll look at yours in a minute. So Merck generally has pretty good markets. It's a $60 stock and they're 6 cents wide. So that works nicely. 2 cents wide here. You could even look out here and they're still pretty tight, 2 cents wide. So that's good. So the first thing we want to do is check out this. That's within 1 percentage point, so that's, or within 2, it's very close to 1. You could even look at this one and that's within 2 also, so it's kind of a pick 'em on where you want to go with those. But I would be, let's check out the chart on Merck. It's got low implied volatility. I can tell you right now it's below 50 without even going back to that other one. Some of these drug stocks have been beaten up in the past, but it is solidly in a downtrend as well. Let me just check in there. And their options cycle comes in the middle of February, so that's probably where I'd want to look to go. So this is where their binary event comes in for their earnings. So something like the 65, 67 and a halves we could look at. Let's just look at the 67 and a halves for, we're going to get about 20 cents there, so we need to sell these to finance that. So we'll sell the 55s and look to buy the 67 and a halves. So about $6.50 we'd be looking to pay. That's where I would start on this, you guys. So anytime you get the mid price, I would go down a couple of ticks and start off bidding it up, because it doesn't cost you anything to cancel, replace an order. If you put it in at the bid price and you get hit, that may have cost you a couple of pennies, and over time that will cost you a lot of money. So it doesn't cost you anything to cancel, replace. I would just send it, and by the time you go back to your monitor tab, you click on monitor, go up there, you know, right click on it, cancel, replace, move it up a tick, hit send. You know, it's going to fill it pretty fast if you're on the market. You know, wait a second. I'm not saying wait 5-10 minutes. I'm just saying wait a couple of seconds. Let it breathe. Move it up until you get hit. So the markets probably are not moving that fast. Do we look if stock's going up or down? I do sometimes. I usually kind of think about the particular stock, whether I think it's overbought or you know, it's due for a pullback in a sense. But yeah, you can do any of that. You know, some people will do this when, you know, you start seeing the moving averages cross, where, you know, it looks like Merck's got the moving averages crossed. It could indicate a bearish trend. So anytime they start to cross over, that is considered to be, you know, an indication of a bearish trend in a sense. So we could look at Merck for sure in this regard. So $6.50, let's say, off of this. So our break even, we subtract the $6.50 from the $67.50. So that gets us at $61. And that's $61. So 40 cents bid ask is a little wide after the market's closed here, but it's slightly below our break even, slightly below where the underlying is currently trading. So again, put that on the short list. The other thing is, I can tell you right now, it's going to fit with this rule just by eyeballing the percentages of it. But just to go through the steps, we've got $12.50 wide market. We've got a $6.52 debit, so we divide that by the $12.50, and it gives us 52. So that's like a 50-50. That's really good for a spread like that, where you're, you know, it's 50-50 chance. That's good probability. So that would work out for sure. And then in that regard, you know, when it's, so I would be collecting, what is that, $5.48. So when I'm at about $2.75 profit, that's when I would look to cover that. So $2.70 profit puts that at about $9.25. I think off the top of my head. So when this is trading around $9.25, that's when I would be looking to cover this strategy if I were to get out. Why do you go so far out of the money for the short strike? Because I really don't want my short strike, for one, to get hit right away. The other thing is I want to have a wider spread so that I have more profit potential. That makes sense, John? I mean, some people will go right here and do the, you know, I've also got to be able to pay for my extrinsic value. So, you know, if I'm selling these 50s, I'm going to have to almost go to these anyway, because if I sell, or 57.5s, if I sell those 57.5s and I bring that spread in a little bit, I'm not going to be able to pay for all the extrinsic value. So I'm going to end up selling this anyway. You could do that as long as you're paying for the extrinsic value. We could look at that, make it a $10 wide. Make it a $10 wide spread, and now we're at 62% the width of the strikes, or 63% the width of the strikes, so that would still fit in line. That would definitely put our break even then. I bet that puts our break even above where we are. So so yeah, we can just do the math. Puts it at 61.22, so that puts us right there. So Thanks for making me look at that, John. We can adjust those just a little bit, and it makes it work. Does that work then? See how I did that? You just make sure that you are paying for your extrinsic value, and that's what we did. So the extrinsic value is probably adding in like a dividend or something like that in there. That's usually what the difference is. If this doesn't match up with what this is paying for, there's probably a dividend added in somewhere. Can I use the Analyze tab? Absolutely. So let's look at this one. Analyze the trade. So this is what it's going to look like. So our max profit is when, it's our max profit is going to be that we got a $10 wide, so $3.72. So $3.72. So that's going to be our max profit on the upside. If it's $3.72, then I'm going to be looking at taking about a dollar. What is that? About $1.80 something added into that, which would make that $8 when this is trading right around $8. That's when I'd probably look to cover that, off the top of my head. And let's squeeze this in so you can see your max loss on that, which is going to be the $628. There we go. So there you go. But remember, if you let this short put go off, then this, will go completely in a slope towards until it gets to zero, basically. So for 50 some odd ticks down. Does that help you out, Trevor? All right, so I think there was another one that I didn't get to. AB. So let's go back to the trade page. AVGO just had earnings. So AVGO, if they just had earnings, we'd have to go out to the April, and it's a little outside our parameters. It's like almost 4 percentage points. So in that regard, there's a lot more extrinsic value embedded in these puts. So we'd even have to go deeper in the money in order to pay for that extrinsic value, which is going to cost us a little bit more. And I don't really like to have to do that. Plus, if volatility started coming out here, that's going to hurt us faster than it would these in the front then. When is the latest time to get out of this trade, and how do we manage it? Well, that's kind of to each his own. My rule of thumb with this is, we take 50% of our max profit, and that's when our target is to get out. I'm not looking to ride this in all the way to the end, taking my put to expiration necessarily. If it's not really working out very well, and we are just kind of trending sideways, and I'm seeing that put decay nicely in the front month, then I will let that come off for that credit. Otherwise, or expire worthless. Otherwise, if it works out right away and I can get that 50% of my max profit, I'm out. I'm not going to ride this into the earnings. Otherwise, I will just probably let it ride out into the earnings. That makes sense? So there's two options there. If it's not really working out right away, then I'm gonna let it ride. If it works out right away, then I'm gonna let that front month expire. I would just let the front month expire. You're asking, and close after the front month expires. If it's not working out, and it's kind of rallying up a little bit, then I will probably let that put expire. If nothing else has changed, if I haven't changed my thought process on this one. If I'm still bearish for whatever reason, then I'm going to let that put expire worthless as long as I'm still bearish. For instance, say I'm bearish gold, and gold has a small rally or just trend sideways, and I'm still bearish gold. I'll let that front put expire, and then have that long put on for the duration until it starts really working out. Does that make sense? All right. Are we going to get the recording? Yeah, you will get a recording for this. So yeah, and that's one thing I forgot to mention, you guys. One thing about this strategy, or about all my webinars for that matter, especially if you're new to options trading or if this strategy is new to you, watch it again relatively shortly after so that it will sink in. Otherwise, you know, if you wait a month or so down the road, it's going to be like learning it all over again. All right, I think I answered everybody's particular. Have a great weekend, Bobby. So I got a couple that I looked at that I, you know, kind of fit my portfolio or my thought process along the way. One was, I kind of just mentioned it, GLD, which is the ETF for gold, and we can look at gold's IV percentile. It seemed to move up a little bit since I was first looking at this, but the IV percent, it's 26, so that's relatively low. We can look at the chart down here. So yeah, it did kind of come up a little bit. But when gold comes off, that's when IV is going to expand. And I think that, you know, with consumer confidence that we saw today, and the University of Michigan was really high, I think that we could see more bearishness in gold, and especially as consumers see the headlines, and you know, I just heard that brokerage for retail investors is going through the roof right now. There's a lot of people coming off and buying on these online platforms, so that is not going to bode well for gold either. So it might be a good time to put on gold. So in that, we got to look and see if they are relatively close, and they are very close in relation. They're well within 2 percentage points, right? They're like 12 tenths of a percent off. So this one could be a good one. And I'm going to look at somewhere around the 30 delta, which is what I like to look for in this strategy. And I'm going to sell that, so I'm going to look to sell the 107s, and I'm going to collect around $1.10, $1.12. So I need to look over here and see where I can finance that particular one, and it looks like I have to go to the 17 puts in order to finance that. Because remember, whatever we're paying here, this is generally very close to what the extrinsic value of this option is, just as a ballpark without having to do all the math. Little floor trader hack for you. And then let's pull up our calculator just to make sure it fits within all our rules. We can really see that it's 10 ticks wide, so it's about 63% the width of the strikes, so that fits within that parameter. But just to do the math, let's do 631 divided by the 10 ticks wide, gives us 63%. So that works. The next thing we need to do is look at where our break even is going to be, and our break even is the 117 puts minus the debit we paid. So the 117 puts minus that $6.31 is going to give us the 110.69. So 110.69 is above where we are currently trading. So that fits all of those rules. The IV percent's really low. We've got our bid ask, our Vega, or our implied volatility in our 2 different months very close. You know, I have a bearish assumption in this, so that would fit my portfolio. I don't have any precious metals in there right now. So all of those things kind of work out for me. So go through that process yourselves and say, you know, maybe I don't have any retail sector in there or things of that nature. So that's what I would do with this process, is go through all those steps. Okay, this fits really nicely now because it fit all those rules. It fits my bearish assumption, and that would be something I would look at for my portfolio. Could you please go over the earnings cycle in relation to this strategy? So what we want to do basically with this strategy is, so this was the Merck one. So what we want to do is we want to sell the option in this month right here. See, it's a clean month. There's nothing going on. You know, it just had their, they're going to have their, that's the one that didn't work out because they have the dividend. So, so we want to have the clean month where we're putting this option on, the one we're selling. We want this all to be clean. And then the put that we're buying, we want that to have the earnings event in it, if at all possible, so that we can take advantage of expansion and volatility. As you can see, for the most part, well, of course, this is a bad example, but earnings, going into earnings, volatility will usually expand because Merck is, you know, a medical one. It's usually going to be around their trials and stuff, probably more so than their earnings, I guess. But what we want is a clean slate in the one option cycle that we're selling, which would be right in through here. And then we would love to have our earnings event within the one that we are buying, because even if we're directionally wrong and if volatility expands rapidly in that one we're long, that can keep us in the profit zone. Right? Did I answer your question on that one? All right, good. Why the 117 strike and not the 116 strike? The cost for this 16 puts would be more than to cover the intrinsic value of the 107s. Let's look at it. So with the gold, so the 116, so 125, so it's 118 to 125, and I ballparked this on the extrinsic value, and it may fall within line there. But I was looking at it, if I'm collecting, you know, you could do the 108s and the 116s. Is that what you were talking about? Rather than, because to me, I mean, just from ballpark, I mean, it may have done the math and that would have covered the extrinsic value, but let's just see. So if we sell the 107s and buy the 116s, the 116s minus this puts us at 1052. So 1052 puts us right there at it. So that works with that rule. So the 6, so that puts us at 109.40 something. So it's about $1 in extrinsic value in there. Huh. So it's pretty, that would work too then. So as long as the 9, so it's got to be, yeah, it's got to make that work. So just to double check though, $5.48 divided by, or sorry, so $5.48 divided by the 9, right? That's where I was going with that. So that puts that 60. You could do that too. But you know, you put your break even right up where the ask is. The other one puts it a little bit higher, and I have a tendency to like it a little bit higher too. But that would work as well, because we've obviously paid for our extrinsic value if this put is equal to where the underlying is trading. That's another way, you know, if your break even is right where the underlying is trading, you're paid for the extrinsic value. That's also another way to look at it as well. All right, for a credit spread, what is the advantages, disadvantages of buying an 80 delta and selling an out of the money delta? For the credit, if you're talking about doing this as a credit spread, is that what you're saying? Like you would be buying this one and then selling that one? I don't know if that's what you're asking. We did this as a credit spread the other way. One thing is it's going to be a lot more margin to do this, and the other thing is I don't like that setup because for various reasons. If you're buying this, then if you're buying that one and selling that one, I mean, you're getting a lot of credit, but you really need to be right. Otherwise, that's a lot of risk. Okay. Thank you, Chris. Appreciate the kind words. I think I've answered everybody's questions on this so far, right? You guys want to look at one other one that I was looking at? Everybody hates Disney, right? Just kidding. Only reason why, like, I was just flipping through charts, to be quite honest, and Disney's had a big breakout here right after their earnings. It's got a pretty clean month here. Also, the earnings would fall within that. So if you think they're going to have like a cruise ship sink or something, which would be bad publicity, but their earnings cycle falls in here. So they got a pretty clean month coming up here. We've got the earnings event in the puts that we've had. They've had a nice big run. They do have a tendency to sell off after earnings, even if they beat earnings. Here's a time where they didn't, but if you look at, generally speaking, they do have a tendency to sell off for some, I guess it's 50-50. So I've always thought that it seems like they sell off after earnings, is my general bias with Disney, just from trading it. But so we'd go and look at the trade window. We could even go, I think we can skip this one. It doesn't fit within that parameter. So, all right, it doesn't work. Would need to be around 19, right? Because now we're at 3%, so it's a little too wide there. That one doesn't work. SPY would work, I think. Thank you, Nicholas. Appreciate it. All right, so let's look at SPY. And even if this one doesn't work out for SPY, it would be if a lot of people have long deltas in their portfolio, which means, you're long stock. Long deltas means you're upward biased, right? You don't want to get too upward biased, because if the market comes down, you're beholden to the market. So if you don't have to have necessarily a bearish outlook. You could look at this like this is a hedge, and a lot of times you actually want to lose money on your hedge because that saves you money in the long term. But if something unforeseen happens and the market corrects or something like that, then you're glad you had that. It's like almost a bit of an insurance policy in a sense. So it's always good to add at least some short deltas, even if you're the consummate bull. So just to protect yourself. So in that regard, let's look at SPY, just in case there is a bit of a correction in the market. So looking at around that 30-ish delta, this is probably the closest one to it. So $2 I'm looking to finance. That would probably be right here at the 231 strike for it. So let's look at the selling the 222 puts and then buying the what was it, the 231 puts. Okay, so we'll look at this one and go through the rules. We've got 9 ticks wide with the $5.38 debit. So we know that's probably going to be inside right around that 60%. So we can take the $5.37 divided by that $9 wide. So yeah, right there at 60%, the width of the strikes. We're inside, we just made our rule on the inside a 2% difference there. Our break even, we can figure out relatively easily. It's going to be close. So we'll take the 231 minus the 538, 5.38, and it gives us 225.62. So we're right. No, we didn't make it. So we can play around with those a little bit and go a little bit tighter and see if we can make it work. So let's do the 223s and the 231s again. See if we can get that to work out. So now we're at 8 ticks wide. Does that put our break even inside that? It's still going to be a little bit below, isn't it? Still a little bit below. Where's my calculator? Shoot. I had this one working out before. What was I getting for a credit? Because this is one of the ones I vetted before. All right, so anyway, moving on. 231 minus that credit or debit we're paying, minus the $5.10. It's at 225. Still not making it. So I'd probably just scrap this, because the tighter we get, the less likely it is we're going to be able to accomplish this. Unless we did something like going to sell the 224s, we're collecting 261, try and do it one more time just to see if it works. So doing the 230s, so now we've got a $6 wide, and I did something wrong. So selling that one, buying that one. $6 wide, $4. It's going to be pretty close. That puts us $4. Still putting us below it. So this one's not going to work out, because if we take the puts, the 230 puts, minus that $4.15, $25.85. It's not working out. So I'd scrap this one. I'm thinking maybe the emerging markets one might have been a little bit even closer than what this is giving us. Even though, I mean, even though that isn't that much of a difference, you know, at the end of the day, it's better off to be, you know, the only thing you can set up with any strategy, you know, is the only thing you can really control is setup and how well you set up these trades in order to increase your probabilities of success. And if your break even is above where you're already trading, you've already set yourself up for success. That's why that's really important, to get above there. Don't try and push it, you know what I mean? All right, so is it your goal to pay for some of the extrinsic value? Not all. My goal is to pay for all of the extrinsic value, because then you have those puts on for their real cost. So then all you're risking is that real cost of that put. You don't have to, if you sell these and buy these and you finance all the extrinsic value, you have them on for the real cost and maybe even a little bit of cushion for the theta decay. So that's why I like to try and go over a little bit. So like when you saw me selling these 200s and going to buy or selling these 222s for $2 and then buying the 231s, I was trying to at least finance all of it. Let me just do it one more time and buy the 32s. Let's see if we can get that to work. That still doesn't work. Still, but it's closer. So I'd probably just not do this trade then. Try and find something else. Maybe go into the DIAs or something like that, you know, the diamonds. Does that make sense for everybody? In terms of dollar amount, how far do you want to be away from the stock price? In terms of dollar amount, I'd like to just be above it. You know, if I was like 20 cents above it or something like that, that's what I'm looking at. 20 cents above it or right at the ask. When is the next webinar? It's going to be on Friday. Next Friday. I do my webinars every Friday at 4:15, right after the market closes. Thanks for asking. All right, so this is the deal we're giving away for almost free for most part, $36. I mean, you guys probably paid more than that in commissions today, and it's like less than going out for taking the family out for lunch. But anyway, with this, you get 20 plus videos. It's basically how do you set up my screen, show you how to set up that market profile, which is that blue screen on the right hand side. That really is what we used on the floor as technical analysis. We didn't use the candlesticks and we didn't use moving averages and stuff like that. We really looked at where the money was being put in the market, and that's what that market profile tells you. It tells you where the most transactions are, the most time is spent, and that is kind of like the comfort food. When it's trading at the most time and volume, that's where the market is most comfortable. When it gets overextended to one side or the other, I talk about all of that stuff and how to set that up and how to trade that market profile. I also talk about the history of options for geeks like me that want to know everything about the options. Talk about different parts of the option terminology. And with next week, we've got the Fed meeting. We're going to have an FOMC. They are likely, looking at raising interest rates. I have my own opinions on that. But anyway, we are in an increasing interest rate environment, and I talk about the importance of how to protect your portfolio, because most people, if you have an IRA or even somebody investing for you, you have a lot of risk on with interest rates rising, and you can't capture it any other way really than to trade options around that. So I talk about all those things and how to options tradings with dividends, stock splits, and more. It's 20 plus videos. Obviously, we don't have all 20 listed here. You also get my daily market commentaries, you guys, which, if you guys are watching those, I go through step by step the winners and the losers. I talk about the good and the bad and how to manage those. The winners come really easy. The losers are the ones that we spend probably 80% of our time managing and trying to make back that money and getting them into profitability. And I talk about all those steps that we go through in order to manage that risk and manage that loser. So you can find that link for this in the chat box. And we've been going back and forth on the questions box, but in the chat window is a link to this offer. You'll also get unlimited access to me. A lot of you guys have been taking advantage of it, where if you have an issue or a trade that you want to run by me, ask me what my rules are on that, or manage a trade that's not gone your way, I'm more than happy to talk to you guys about that. I don't want to see anybody losing money for that matter. And the reason why I want to educate you guys really is because if we are all doing well, we make tighter markets. And maybe it's a little bit biased or whatever, but if you guys are out there and trading well, you guys are going to make better markets for me. I'm going to make better markets for you, and that will save us all a lot of money in the long run. And the beauty in options is there isn't a winner for every loser. There's so many different strategies out there. I could be buying a call, and you guys are selling a call spread. It just makes those markets tighter. We don't always have to have the exact same thought process in order to still make money. Anyway, so future webinars, I'm going to be drilling down on other options components, trades I find, when and where I find them appropriate. Also reach out to us at Pro Trader Strategies at trading@protraderstrategies.com if you have anything that you want to talk to me about, or if you have a webinar like Trevor mentioned, to do a longer webinar on implied volatility to understand that a little bit more, because nobody else is really talking about it. And you can contact us at 310-598-6677. You guys, the price of this is the link for that webinar also. I mean, the price of this, you guys, you got to be trading with this knowledge in order to be successful. The only thing you guys can do, and even like with that festival of traders that I participated, I was a speaker in. I watched all those guys. You know, I can take something away. I've been trading for over 20 years now, and I can still learn. So that's what we need to do, is keep learning, keep evolving, we keep getting better. So take advantage of all that stuff. The more knowledge you can throw in that gray matter in between your ears, the better trader you will be. And this whole thing is set up to make you more consistent for sure, using all these techniques and these rules. You know, I'm playing probabilities. When somebody was asking, you know, chart patterns and stuff like that, I really don't look at that a whole lot. I do look at the charts a lot just to kind of confirm myself, make sure there's nothing wanky going on. But for the most part, I'm looking at probabilities and my own thought process, what my portfolio needs, stuff like that. All right. Chris, hello, Eric. Just followed your philosophy and working the profit wheel. Sold covered calls and cash secured puts. Rolled the calls during the recent rally and the puts expired worthless. Planning to sell puts and roll them as and when required. I feel good about the strategy is working. Many thanks again to you. Thank you, Chris. I appreciate that. Jan, thank you very much. Try the analysis trade. All right, great. Or the analyze trade. The one we analyzed, good. Have a great weekend. Appreciate it. And Gills, you got taken care of. All right, Trevor. Trump wants to increase interest rates. Do you think it's wise? I don't think it's wise right now. I think they should wait till after the Christmas holiday. The reason why is because when the consumer sees interest rates going up, why do they increase interest rates? They do it to crimp spending. And why on earth would we want to crimp spending going into a holiday season after we've had this long slog of bad economic environment for the last several years? Why would we want to crimp spending right now? Why not let inflation kind of go a little bit, let it run a little bit? We are not seeing real high inflation, but let these people spend, let everybody, you know, build up their coffers a little bit. And then at the beginning of the year when nobody's looking, that's when you kind of raise it. So then it doesn't change that mentality. But right now, everybody is hypersensitive about it. So why do it? I would wait till the next one if it were me. But, you know, this latest FOMC doesn't have a problem raising it at the time of year where we call it, you know, they call it Black Friday, because that's when the retailers go from being in the red, losing money all year, to being in the green, or being in the black. That's, you know, accounting term. You write in red when you're losing money and you go to black when you're starting to make money. So why crimp spending right now? I don't get it. Anyway, a few words about SPX, please. How do you see the near future? I think we could easily see a real big pop coming. We had consumer sentiment come out. Consumers are really confident. We're seeing brokerage firms make tons of money. A lot of retail investors are coming off the bench and starting to invest. But word of caution, that's usually the retailers' timing. The retail investors' timing is usually the worst. They get out at the worst time, they get in at the worst time. So what does that tell me? It's starting to near a top. So when retail investors start getting in, you got to be worried. So, but I am always worried about the downside. So any adjustments to the diagonal? Great question, Trevor. I forgot to mention, yes, if you are in something that has a lot of volume and open interest and you can get into those weeklies, you know, obviously what you would want to do is roll out in time and down away from the market. So if you're able to do that and collect another credit, then that's the way we do that, because you can collect more credit that increases your break even higher than where it was before, and you can roll it out through those weeklies. So yes, take advantage of that. If, you know, the market starts rallying a little bit and you see those puts that are out of the money in the near duration. You can roll it out and try and roll out and down. Make that spread wider. It increases your max profit. It also gives you more wiggle room to the upside. This is an aha moment. Thanks. Appreciate it. So great question, Trevor. I should have mentioned that a little bit earlier. But yeah, you can roll out through the weeklies for sure, especially if they're, tight bid ask. The last thing you want to do is roll out and through those weeklies and you have to give up so much edge that it really kind of doesn't help you out. All right, so like I said, take advantage of that, you guys, right there in the chat box. I'm going to let you guys all go. Have a great weekend. Thanks for all your participation, because I think it makes it a lot more fun for me, and I think that it helps out everybody else when we can see it go back and forth and build it out right through from start to finish, when I'm not just going through the ones I've already vetted for the most part. So I'll probably be looking to do that GLD trade on Monday. So if you're watching the daily market commentaries, look for that one, right? And that's all I got for you guys. Have a great weekend. If you can't take that, take it easy.